Hope all of you are doing fine. Today in the increment series, we will be talking about the union budget. As you know, that union budget is around the corner. 1st of Feb, you will find the final union budget of our country, and ultimately, what all changes are there, we will come to know. But when it comes to the Indian economy and Indian financial system subject, what all is important for our examination that we must focus upon, and moreover, the updates till December 2025 are in our curriculum. But again, if you do not know the basics of union budget, you won't be able to interpret it fully. So let's get started. First of all, where does the union budget lies? It lies in the economic policy, which is known as the fiscal policy. So fiscal policy more or less is being run, or for that matter, is being structured by the finance ministry under the government of India, and the primary motto is to stimulate the economic growth of our nation through this fiscal policy. And under this fiscal policy only, we have one of the most integral part of the entire economic policy whatsoever in our country, which is the government's revenue as well as expenditure. And how we study this particular government's revenue or expenditure via the union budget. So union budget more or less, it tells us that what is the earning of the government, fine, earning of the government, normally known as the revenue, and what all the government is spending, which is known as the expenditure. The study of both, the interrelationship of both, and what all components are there, this is studied under your union budget. So what are the objectives of fiscal policy under which lies the union budget? So there are two types of objectives. One is the primary, second is additional objective. The primary one, as we have just seen, it is the economic growth. So the primary objective, promoting the economic growth, maintaining price stability in the economy. So more or less indirectly, the inflation must be controlled so as to provide the price stability, and inflation will be controlled using the monetary policy at the best possible scenario. Then we have the additional objectives. What are the additional objectives? Simply, whatever the resources are being allocated using the union budget, that must be mobilized, fine. That must be utilized for whatsoever purpose it has been given to you. So mobilizing the resources, promoting the allocative efficiency. What is this allocative efficiency? The particular task for which the budget has been allocated to you, whether it has been implemented or not. Reducing the inequality in income and wealth. So whenever we say that economic growth, it somewhere starts with the promotion of your social welfare as well. Fine. Only economic growth won't help us. We must move towards the economic development also, which is more or less uh, one of the component of your social welfare. Lastly, to promote the private sector investment, and specifically for our country, it is much more needed. Why? Because our expenditure is very, very high, and the revenue with the government is pretty low. Fine. So normally we see that there is a deficit in our budget. Fine. Every time we talk about this thing only. So these two objectives, can they ask in the exam? Yes, they can. They can directly ask you that which of the following is are the additional objectives of the fiscal policy in India, specifically for our country. So if I say that promoting economic growth is an additional objective, the answer would be a wrong answer, because it is the one of your primary objective. Like that, you must be very, very clear in all these objectives. Now comes the discussion that what is a union budget? Simply stated, the annual budget of the country is known as your union budget. Fine. So union budget 25-26 we already have with us. We have analyzed it, and now 26-27 you will find it on Sunday. So 1st of Feb will give you the union budget of 2026-27. It is presented by whom? By the Union Finance Minister in Parliament. It was being presented on the last working day of Feb till the year 2016. So there are certain changes which have been made, and we must know that. Earlier it used to be presented on the last working day of February. fine, till 2016. After that, it has been shifted. The date has been shifted to 1st of Feb. And when we talk about the rationale why it was done, because when the budget was presented on the last working day of Feb, we used to have only March, right? Only March month was there, and after that, from 1st of April, you have to implement the budget. How you can implement with such a small time, only 1 month? Now, in order to give additional buffer to the various government departments, the union government has decided to present it on the 1st of Feb, so as to give them additional 20 odd days, right? 20 plus days for the implementation. The rationale behind this change is to provide time to the government to implement it from the 1st of April when the new financial year starts. Also, this is what the first change which happened since 2016. The second important change is this. Another change which has been introduced from the year 2017 is that rail budget, which was earlier presented separately by the Union Railway Minister, has now been merged with the Union budget only. So earlier, what used to happen? We used to see one union budget, and then second, a separate rail budget was presented. But now, since 2017, what are we witnessing? A single union budget under which we see the rail budget as well. Fine. So no separate budgets are there which are being presented. Budget is there, but the presentation is done by the finance minister only. Earlier, what used to happen? Union budget used to be presented by the finance minister, and rail minister will come and deliver the speech for the rail budget. But now it has been merged with the union budget, and singular your union finance minister will be presenting the budget. Now comes the question that the theoretical part is okay. Everybody knows that why budget, how budget, but whether it has a single component or multiple components with it. The money comes, the money goes. Where do we present them? Where do we enlist them? All these questions will be carried forward, and the discussion which starts will be from the budget. So the budget has two types of accounts, right? Normally we see in our class that how you can have the analogy of budget is that just imagine you have a wallet, and you are having one wallet, and in this particular wallet there is money from various accounts. One can be HDFC, another can be State Bank of India. These are the two accounts from where the money is in your purse, in your wallet. And just imagine this wallet to be your budget. Fine. This is the budget, your monthly budget or annual budget, whatever you can think of. Now, there is one bank where you keep the money for long term, and you are not utilizing it often. The another one you keep for short term expenses, the more regular expenses, the monthly expenses. Fine. All of us mostly we have this kind of arrangement in our banking for our financials. Similar is the case with the government also. So budget, the wallet we are saying it is just the budget, the union budget, where you have two accounts, revenue and capital account. The revenue account is for all those spending, or for that matter, all those earnings which are short term, which are happening within 1 year, less than 1 year. Fine. So the short term expenditure, the short term spending, or for that matter, short term earning will be credited or debited via your revenue account. Now, what kind of spending can be there on regular basis within 1 year? So the salaries of the employees, fine. This is the short term spending of the government, right? So we have a revenue account for that. Then short term earning will be what? Some interest earning on regular basis, right? That will be credited in the revenue account only. So salaries of the employees will be what? It will be debited from the purse of the government, and that will be the revenue expenditure for the government. The short term subsidies, you can say, again revenue expenditure of the government. Similarly, the interest earning, the short-term interest earning, the regular interest earning of the government, it will go towards what? Towards the credit. It will be credited in the purse and will be highlighted in the revenue receipt. Similarly, capital account. What is a capital account? It is for the long-term transactions. Fine, long-term transactions. There will be certain amount which will be credited over a period of time, over a time period which is greater than 1 year. There will be certain amount which will be debited from the particular purse of the government known as the capital account, and it will be debited for a longer duration greater than 1 year. Like what? So whenever we have some loan setup, fine, loan from IMF or for that matter other international organizations, you have to provide it back to that particular organization. So it is what? Long-term loan. So it will be reflected where? In the capital account. Similarly, the earning of the government, if the government has given, let's suppose, loan some money to the various countries, let's say Nepal or Sri Lanka, that will be from where? The recovery of those loans will be in the long term only. The Sri Lankan government won't be giving you the loan within 10 days or 1 month. No, beyond 1 year they will take. So that is again what? A long term earning which will be uh, in the form of interest earning from that particular country. It will be reflected where? In the capital account. Fine. So similarly, capital account also has capital revenue, the earnings we are saying, and capital expenditure, the spending of the government. Okay. Now, when we talk about the revenue receipt, it is of again two types. One is tax receipt, another is non-tax receipt. Since the government purse is mostly credited by the taxes. Tax forms the largest corpus for the entire budget of the government, fine, entire receipt of the government. That is why we have a separate component as the tax receipts. All those short-term earnings of the government will be from the non-tax receipts. Fine. Beyond tax, or for that matter, the earnings apart from the taxes will be reflected on in the non-tax receipt. Then we have capital revenue again of two types, the two components. One is debt creating, second is non-debt creating. Now here we were discussing that there is a long-term loan from IMF. So as soon as this particular loan is being provided by the IMF, our capital account will be replenished because there is some money which will be credited. When you have taken loan, the money will be credited to your account, but whether you have to pay some interest on this, or for that matter, along with this interest, whether you have to repay it back. So yes, a debt has been created on our country and it will be reflected where? In the debt creating under the capital revenue only, because the sum has been credited, but again it has created certain debt. Fine. When we talk about the non-debt creating, what is non-debt creating? Simply stated, the money which you have given to Sri Lanka and now they are repaying it to you, paying back to you over a longer period of time. You need not to repay the money to Sri Lanka again, fine, because that is your money which you have lent to Sri Lanka, and that money will be under this head of non-debt creating. Fine. So I hope that this complicated diagram, this complicated structure will be very much easy for you via these examples. You will be able to understand everything, irrespective of the fact that whether it is difficult or not, once you know that this is the basic structure of budget. So budget, again, I'm reiterating the fact, it comprises of two major heads. One is your revenue account, another is capital account. Revenue account, less than 1 year, all the transactions, be it spending or earning. Greater than 1 year, capital account, irrespective of the fact whether it is spending or earning. Revenue account has two heads. One is your receipt, the credit, and the second one will be the expenditure, the spending, the debit. Capital account also, one is your capital revenue or capital receipt, you can call it, or for that matter, capital expenditure, the debit. Revenue receipt has two separate components. One is the tax receipt, another is non-tax receipt, capital revenue, debt creating, and non-debt creating. Fine. So this structure, I hope that you are able to understand. Still, you have any doubt? Feel free to ask me in the comment section. Now comes a particular point which we were discussing initially also, that why do we see a deficit? Fine. There is revenue, which is the earning, and then there is expenditure, which is the spending. So in India, since we are a developing nation, so government has to spend on the infrastructure. Plus, we have poor people also. Fine. The good amount of our population lives below poverty. More than 50% of our population, they are not even having the basic necessities whatever they should have. So for them, good amount of money is being spent by the government, so expenditure is high. But the revenue, as I was telling you, only the taxpayers are the regular, you can say, individuals who are providing the money via the taxes. So the tax receipt only contributes to the major portion of the government's salary, or for that matter government's purse, government's budget. So again, that is much more, or I would say way less than the entire expenditure, right? So solely depending on the tax, mostly we see, so the revenue is always more or less at a lower side only. So this particular gap where revenue is much more less than the expenditure, it will create what? It will create a deficit, right? There is a deficit in your budget. And this budgetary deficit, how we can study? We can study it via two components, via two methods. One is your revenue deficit, second is known as fiscal deficit. So revenue deficit talks only about this account, that is revenue account. It is not talking about your capital account. So revenue account, how you can calculate? Just simply the difference between the receipt and the expenditure under the revenue account. So revenue deficit is the gap between the government revenue expenditure and the total revenue receipt. As your expenditure is much higher as compared to the revenue, so always remember it will be expenditure minus the revenue, not the other way around, from both the tax as well as non-tax sources. Fine. Tax as well as non-tax sources. Fine. Revenue is from these two. So we will add these two components and subtract it from the revenue expenditure. We will get the revenue deficit. So total revenue expenditure minus total revenue receipt, you will have the revenue deficit. But think for a while and tell me whether this gives you a complete picture or not. Only studying the revenue account for the deficit, whether it will give you the complete picture of the budget or not? Answer is no. You should include the capital account in your study as well. So the comprehensive, or for that matter, the complete study of deficit must include both the components, and inclusion of both these components is done where? In the fiscal deficit concept. Fiscal deficit, it is just the excess of government spending over its earnings. So what we will do, the total expenditure, which includes what? Total expenditure includes capital expenditure plus revenue expenditure. We have to subtract it from capital revenue plus revenue receipt. Fine. So total expenditure minus the total revenue. That is the step one. Okay, and this total revenue includes what? The total expenditure. It has both the components: expenditure from the revenue account as well as the capital account. And when we talk about total revenue, it is also from both, be it from the revenue account as well as the capital account. Right? So this is the first step of identifying that what is your fiscal deficit. But along with that, one particular component which we were just discussing, that was borrowing. So like here in this particular example, I was telling you that government has taken loan from, let's suppose, IMF. So this particular amount is, it does not belong to our country. We will be repaying it. So all such borrowings must be excluded. So you are doing what? Total expenditure. Expenditure means what? Total spending minus the total earning. But these earnings, they should not include any borrowing because they will be repaid. Fine. So that is the formula which you should remember for the fiscal deficit. So two important formulas, revenue deficit and fiscal deficit. I hope both will be there in your mind while attempting the examination. In India, now we utilize only fiscal deficit. Fine. So this was it for today's class. If you want a comprehensive discussion regarding the entire unit, regarding the entire IFS, you can enroll in the JAIIB Mahapack, where right now you are having the last chance to avail the 3x validity on the Mahapack, and the huge discounts are ongoing. Effective discount is more than 82% if you utilize the